conversation, let's start with a true story. I met with a woman, she is 67-year old and still works full time in a bakery. In New Zealand, the retirement age is 65. So I asked her, "Why do you still work full time? Don't you get government pension?" She replied, "I do get $1,000 fortnightly. But if I don't work full time, that money is only able to cover my rent. What's gonna happen to my other bills?" And that got me thinking. At the age of 65, if she is unable to retire, what's gonna happen to a 25 or 30 years old? Inflation increasing every year and the cost of living rising. Do you think when you're gonna be 65, the things will be easier? Well, I don't think so. That's why I believe financial planning is very important. I started planning mine 3 years ago and started investing. Today I am confident in next 10 years I will be able to retire. Hey everyone, my name is Ricky and welcome to Peaceful Investor. This channel is about simplifying investing and achieving financial freedom. Remember, I'm not a financial advisor. The content here is only for educational and informational purpose only. Now, let's talk about a company called Adobe. Adobe just shared their latest results and the numbers are big, but the real question is, should you think about investing in this company right now? In this video, I'll walk you through who Adobe is, how they make money, what their latest earning look like, and whether the stock price makes sense today. I will keep it simple so everybody can understand. Adobe is one of the most important software company in the world. You have probably heard or even used their products. The first part of their business is called digital media. This is tool like Photoshop, Illustrator, Acrobat, Firefly, and Express. These are used by students, professionals, creators, and small businesses. This makes up about three-quarter of Adobe's total revenue. The second part is digital experience. This is for big companies. It helps them understand their customers, run marketing campaigns, and personalize ads. Products here includes Adobe Experience Cloud and Gen Studio. This is about one quarter of revenue. So in short, Adobe makes money in two ways, helping individuals and creators make content and helping big companies manage and grow their customer experience. Now let's quickly look at how Adobe has grown over the years. Revenue in 2017, Adobe made about 9 billion in sales. Today that number is over 23 billion. That is more than double in 7 years, showing steady growth almost every single year. Gross profit. Back in 2017, the gross profit was around 7.7 billion. Today it is about 20.5 billion. So that means Adobe has been able to keep very high profit margin while scaling its software subscriptions. Operating income. This is profit after expenses like salaries, research and development, and marketing. In 2017, it was $2.8 billion. Today, it's around 8.5 billion. So Adobe's core business profit has tripled in 7 years. Net income. This is the final profit after everything, including taxes. In 2017, Adobe made about 2.6 billion. Today, it's nearly 7 billion. That's also more than double, showing Adobe continue to grow its bottom line. And finally, the most important, free cash flow. In 2017, Adobe generated about 3.8 billion in total free cash flow. Today that number is close to 7.9 billion. So this means Adobe turns a big portion of its revenue directly into cash, which it can use for buybacks, paying debt, or investing in new products like AI. Alright, let's break down what happened this quarter in detail. Total revenue. Adobe brought in 5.99 billion, which is an 11% increase compared to the same quarter last year. That's a solid double-digit growth for a company of their size. And in the segment wise, from the digital media business, Adobe made 4.46 billion, which is up 12% year over year. From the digital experience business, revenue reached 1.48 billion, growing nearly 9%. This side of the business is more enterprise focused and it continues to expand steadily. The company's gross profit came in at 5.35 billion, up about 10% from last year. Even with this higher cost from AI and cloud infrastructure, Adobe is still keeping very strong margins. Operating income was 2.17 billion, which is an increase of 9%. This means after covering expenses like salaries, marketing and R&Ds, Adobe is still scaling profit in line with the revenue growth. Net income, bottom line net income reached 1.77 billion, up about 5% year over year. The growth rate here is little slower because expenses and the stock based compensation was higher, but it's still a healthy result. EPS came in 5.31, which is a 14% jump. This was boosted by Adobe's large share buyback, which reduced the number of shares in the market and increased EPS. The annual recurring revenue for digital media rose to 18.59 billion, which is almost 12%. That tells us Adobe's subscription model is continuing to grow steadily. And in the digital experience, this segment added 1.37 billion, which is 11% growth year over year. Again, another sign of solid subscription expansion. Adobe also reported 5 billion in annual recurring revenue influenced by AI and already reached 250 million for artificial intelligence first annual recurring revenue, meaning customers are paying directly for new AI tools, new contracts. And importantly, Adobe signed 750 million worth of new contracts this quarter. Their total remaining performance obligation are now 20.44 billion, which is 13% more compared to last year. So that's futures revenue locked in. So if there is any new investors watching this video right now, you must be wondering what is RPO, which is remaining performance obligations. Think of like RPO as Adobe's backlog of future sales. These are contracts customer have already signed and committed to pay for, but Adobe hasn't delivered yet. In simple terms, it's like Adobe already has billions of dollars in orders waiting to be fulfilled. This quarter, Adobe RPO reached 20.44 billion, which is up 13% from last year. And just in this quarter alone, they added 750 million in brand new contracts. For us as investors, that's exciting because it shows there is already logged in growth coming in future quarters. Now let's talk about margins because here where things didn't look as strong. Even though revenue grew double digits, the gross profit, operating income, and the net income didn't grow as fast. Why? Because costs are rising. Adobe is spending heavily on AI infrastructure and cloud costs to scale Firefly and Acrobat AI. R&D and marketing to push new products, and stock-based compensation, which alone was nearly 500 million in this quarter. So that means margins compressed, and as investors, we don't want to see margins going down. We want profits to grow faster than revenue, not slower. Adobe's management explained that this dip is temporary. They are investing more in AI and enterprise tools which they believe will bring in stronger growth and higher margins in the future. Now let's talk about the real power of Adobe cash flow. In this quarter, Adobe generated $2.2 billion in operating cash flow. After taking out spending on property and equipment, the free cash flow was about 2.1 billion. So that means Adobe turned more than a third of its revenue directly into cash, a very strong sign of efficiency. One thing to note is stock based compensation, which was about 497 million in this quarter. That dilutes shareholder over time. but Adobe is actively offsetting that dilution by buying back its own stock. In fact, this quarter they purchased about 8 million shares, spending 2.1 billion on buybacks. So even though employees get shares through stock compensation, Adobe reduces the overall share count with these buybacks, which helps protect and even boost earning per share for investors. At the end of quarter, Adobe had about 5 billion and in cash and 9.4 billion in total current assets. On the other side, debt has risen to 6.2 billion compared to about 4 billion a year ago. But the key investor takeaway here is with Adobe producing around 8.5 billion in free cash flow every year, that debt is still very manageable and the company can comfortably fund investments, buybacks, and growth. Growth drivers and outlook. The first AI integration tools like Firefly, Acrobat AI Assistants, and Gen Studio are not just buzzwords. They are starting to bring in real money. Adobe already reported 5 billion of annual recurring revenue influenced by AI and $250 million in AI first ARR where customers are directly paying for AI features. Second, enterprise adoption. Large companies are signing up for Adobe's Experience Cloud and Cross Cloud deals. Those cross deals grew about 60% year over year, showing big corporations are leaning on Adobe's to run their marketing and customer data platforms. Third, subscription keeps expanding. Both digital media and digital experience ARR are climbing steadily, which means Adobe's future revenue is getting more predictable and recurring. Fourth, and this is big for investors, share buybacks. Adobe's management has massive buyback program of 25 billion authorized through 2028. Just this quarter alone they purchased about 8 billion shares of 2.1 billion dollars. Why is this important? Because share buybacks reduce the number of shares in the market. So that means each share you own represents a bigger slice of the company. It also helps offset stock based compensation, which we talked about earlier, and it pushes earnings per share higher over time. So, when a company like Adobe consistently generates strong cash flow and then uses it to buy back on stock, it shows management is confident in the long term value of the business and want to reward shareholders directly. Looking ahead, Adobe expects that momentum to continue. Next quarter, revenue is expected to come in between 6.08 and 6.13 billion, which would be about 7 to 8% growth compared to last year. Earning per share should grow around 11 to 12% on a non-GAAP basis. For the full year, management guided for revenue between 23.65 billion and 23.7 billion. That is about 10% growth for this year. They also see non-GAAP EPS climbing about 13% year over year. So even after pouring money into AI development and returning billions to shareholders through buybacks, Adobe is still guiding for solid double-digit growth. That tells us company is confident in both its business model and the demand ahead. Adobe share price is about $349 today. It used to trade much higher, but it came down a lot even while the company kept growing. Sales, profit, and cash flow all moved up over the years. So, why did the stock get punished? First, the market didn't like a few soft outlooks last year. Adobe beat results but guided below what Wall Street wanted in March, September, and December 2024. Each time the stock dipped because investors worried AI gains might take longer to show up. Second, there is a competition and AI noise. Some investors fear new AI tools could pressure Adobe's growth. Even when Adobe posts strong quarters, headlines still question if AI will truly boost results. Third, the very famous the Figma deal. Adobe ended the $20 acquisition after regulators pushed back and paid a $1 billion termination fee. That didn't change the core business, but it hurt GAAP results and investors' confidence. By the way, I have explained Figma's business in another video, so check that out if you want the full picture. Fourth, there was a trust backlash in mid 2024 around Adobe's terms of service. Creators worried Adobe might use their work to train AI. Adobe later clarified it won't. But the episode hurt sentiment with parts of creative community. Fifth, the valuation came down. Early last year, Adobe traded at much higher multiples. Now it's around 15 times forward earnings and 21 times trailing 12 months earning. Far cheaper than its history. This is classical multiple compression. The price fell more than the fundamentals. This is how market work. When sentiment turns negative, big investors often sell, even if the numbers look fine. We saw it with Alphabet when ChatGPT launched. Everybody started selling Alphabet. Fear pulled the stock down, but steady results slowly changed the mood. Now, Adobe price is lower, but the business is still growing. Annual recurring revenue is climbing, new contracts are being signed, and AI features keep expanding. So in my view, at this price, Adobe looks very attractive. It's a double-digit growth business with a strong cash flow. I will start with a small position and build over time if the execution stays strong. But if I'm buying, it doesn't mean you also have to buy. Please do your own due diligence before you invest in this company. And please, if you like these kind of videos, don't forget to subscribe. And I will see you in my next video. Thank you.